Welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Welcome back to our beginner options trading educational platform, because today we're here to review what we've discussed over the past couple of education sessions. So this is a beginner's options trading course that we're currently wrapping up, where we talked a little bit about the benefits of trading options, where we looked ahead for those of you that are learning how to trade options to get a better understanding as to how options can benefit your portfolio and the different types of strategies that you'll be able to deploy and what they will do in terms of benefiting for your portfolio. And then we spent quite a bit of time talking about the true difference between buying versus selling options. We talked about the four fundamental building blocks of all option strategies, which is buying calls, buying puts, selling calls, and selling puts. So today what we're going to do is we're going to do a deeper dive with some real examples to show you just truly the difference between buying versus selling options. So because that is the fundamental building block that you're going to need in order to trade more complex strategies, to even trade simple strategies like cover calls, cash secured puts, buying calls, buying puts. How do you decide which one's best suited for you? Today we're going to try to go through as many real examples as possible to provide you with the context to take what you've learned over the past few weeks and apply it to the real markets. So let's go ahead and get started. Now, before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So the primary question that I want to help investors answer at the current moment with the context of the broader markets is really, can Nordic markets continue to push higher? And we will be looking at some of the broader markets in terms of the indices across the four Nordic regions and take a look at where we see some outperformance, where we see some opportunities. And then we're also going to take a look at some individual stocks and set up some bullish and bear cases to show you how we would apply what we've learned to real trading strategies. So let's go ahead and get started. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I'm going to do here today is take what we've learned here, or what I've taught over the past few weeks, and help you apply it to the real markets today. So these courses are always going to take this type of format where we spend 2 sessions learning concepts and theories on options. And then we always take a pause on the third course. Instead of learning something new, we take what we've learned and we show you how to apply it to the real markets. We find that that's a much better way to hopefully help you better grasp the concepts for actual trading for your portfolio. So in the previous sessions, we talked about 2 things. Number one, the benefit of options. So on that course, we talked about the 4 fundamental building blocks: the buying a call, buying a put option, what that means from a contractual perspective, selling a call, and selling a put. What does that mean from a contractual perspective? Buying an option gives you the right to buy or sell the underlying stock at a specific price at a specific time before a specific time. As a seller, you're obligated to do what the buyer wants, the option that the buyer. So if the buyer wants to buy, the seller must sell it to them. If the buyer wants to sell, the seller must buy it from them. So whenever we're talking about buyers and sellers, these are 2 traders that are on the opposite side of each transaction. So what we explored were these 4 contractual obligations, if you will, that the buyer versus seller of a call or a put needs to have. And for those of you that trade equities, this is a little confusing at first, because when you're trading equities, you just either go long the stock or go short the stock. That's it. And for many investors, you only buy stocks. You may never even short sell stocks. So you really have only one trading strategy. Here, now you have 4 trading strategies. So it's really important to understand these 4 fundamental building blocks, because if you don't understand them, it's really difficult to take it to the next step of either applying it to your portfolio or trading more complex strategies, or deciding which one's best suited for you, right? So are you better off buying a call option if you're bullish, or are you better off selling a put option if you're bullish? So this is really what we spent the second half of our course learning more about, is really the difference between buying a call option and what you're really getting for that, and what you're trading off when you're buying a call option. So for those of you that missed those sessions, I will show you at the end how to access those courses, because we do have those courses available to you to watch. So you can go to our education session, you can go to our webinar recordings, and you can see the recordings that we have made for these courses. So you can actually see the recordings from the September 16th one, the benefit of options. You can see buying versus selling options. This is a course that I highly recommend that you watch if you missed any of those courses. And I just posted a link into the chat window if any of you have missed that. But during that course, we talked about the fact that when you buy an option, it's not fair to say just buying an option is bullish, because what you're really doing is you're trading off unlimited upside in exchange for limited risk, for the fact that the stock needs to beat the break-even price before you're profitable. When you buy a stock, as soon as the stock goes higher, you make money. When you buy a call option, you have to factor into the cost of that call option into deciding as far as when the strategy will actually make money. And you have to overcome that cost before you break even and before you start making a profit. So that's the biggest challenge with buying call options or buying any type of option, is the fact that there's a cost to buying that option, and you have to overcome that cost before you can make a profit. On the flip side, when you sell an option, you have what we consider fairly poor risk to reward, because the amount of money that you can make is fixed. There's a cap as to how much money you can make, but how much you can lose is actually uncapped. You can continuously lose more and more money if you get the directional view of an underlying stock incorrect. But the benefit of this strategy is that it's a very forgiving strategy, meaning if you get the directional view right, you make money. If the stock doesn't move anywhere and stays where it is, you make money. If the stock goes against you, meaning you could actually get the direction wrong and still make money. The only time you lose money is if you get a big move to the downside in the opposite direction that you expect the stock to move in. So it's a very forgiving strategy. It makes profits in a lot of different scenarios. And this is really what you have to decide as a trader, is to which option strategy is best suited for you. Do you want to take on a fair amount of risk in exchange for limited reward so that you can make money in a lot of different scenarios? Or do you want to take on the risk profile where you can make unlimited rewards in exchange for limited risk? It's just that you're going to lose money if the stock doesn't go in your favor. You're going to lose money if the stock doesn't move. You're going to lose money even if the stock goes in your favor, but not far enough. You only make money if the stock makes a big move to the upside. That's the biggest challenge to learn as an options trader, is these are the two choices that you generally have when you're thinking about a bullish view on the markets. So I think the best way to learn this is to use a real example. Now, what I'm going to do is I'm going to use a stock that we can look at together. Whoops, 1 second. I'm going to look at a stock together, and we will take a look at buying a call option versus selling a put option. If you can understand these two strategies, the difference between these two strategies, and truly understand when it's best suited for you to use buying a call options versus selling a put option, you are already way ahead of most options traders. And if you can understand that and conceptually analyze it, then all other strategies, when you get into vertical spreads, debit versus credit spreads, it's all based on this fundamental understanding, which is why, again, I think it's so important that we spend the time to learn. So I'm going to take a look at a stock, ASA Abloy. And the reason I wanted to take a look at this stock is just because the technical setup, I think, is pretty interesting here. You have an ascending triangle here, and it's just touching the top of that triangle here. So the view here is that the fact that you have this 215 relative high, and then you have this ascending triangle, what this projects is a move potentially here to the upside. And what we can do is we can use technical analysis to measure this move, which is roughly 20 crowns, to a projection to the upside. So 215 plus 20 crowns is about 235. So what we can use is we can use technical analysis to say, okay, this stock is about to break out from this 215 zone. That's a good looking chart. If we do get a continuation higher, we could get a move all the way up to 235, which also happens to be the next resistance level here around 236. So those are things that really line up pretty well. So let's compare two option strategies that can potentially make us capital if our directional view of ASA continues to move higher would be profitable. Okay, and the first one is going to be buying a call option, and the second one is going to be selling a put option. Now, this is the OptionsPlay platform. For those of you that are brand new to this platform, the platform is designed from the ground up to make your options trading as simple as possible, so that you're not necessarily using just the options chain to make your decisions, that we have a much more visual way of showing you the strategies themselves. We have different tools to help you compare strategies side by side and truly understand the risk and rewards of each trade before you place that trade. And this will help you also decide which strategies for you. So we're going to use this tool today to give you a better understanding of the difference between buying a call versus selling a put, which is very, very important for options investors to understand before you start trading it. Now, ASA's trading about 214.5 right now. So what I'm going to use is I'm going to sell the November 215 puts, which is the at the money put, and I'm going to compare it to buying a November 215 call option, which is the at the money call option. And what you'll notice here is that it'll cost me about 760 crowns to buy the call option, but I will collect 790 crowns to sell the November 215 puts. So remember, as a buyer, you have to pay to get into the option contract. As a seller, someone pays you to execute that option contract. So when you're a buyer, whatever you pay, that's what you have to overcome before you make a profit. As a seller, whatever you collect, that's the buffer that you get, so that if the trade goes against you, that's the buffer that protects you from losses before you start experiencing losses. So when you're buying an at the money call or a put, you should expect that the call or put premiums to be very close to each other. They're not always exactly the same, but they generally speaking are not very far from each other, especially if you're dealing with something that's, that only is true when you're talking about an at the money call or put. But whenever you're trading about an at the money call or put, the call and put generally speaking will have very similar premiums. So here it'll cost me 760 crowns and I'll collect 790 crowns. And what that does is just starts to give you a better idea as far as when these strategies will be profitable. So this break-even price is 222.60. Because I have to add 760 crowns or 7.6 crowns to the 215 strike, that comes out to be 222.60. So the stock has to be above 222.60 by November 20th in order for this strategy to be profitable. Now, does that make sense to everyone? Please type 1 into the chat window if that makes sense to you, why the break-even price is 222.60, because you have to add the 7.6 crowns to the 215 crowns. That's your break-even price. So 222.60 is around right here, right? Well below kind of our 235, 236 target. So you're thinking to yourself, okay, at the very least, if it reaches my 235, 236 target level, I'll be profitable. However, what you have to remember is that 222.60 is only your break-even price, meaning if the stock is at 222.60, you're not making any money. You're just not losing any money, because any price below 222.60, this strategy will actually lose money. So you have to first of all believe that the stock is going to, at a minimum, be above 222.60, but that's not enough. You have to believe that the stock's going to be well above 222.60, because you're not going to make trades just to break even. You're making trades to try to make a profit. So you have to ask yourself, well, if the stock gets up to 230, how much money do I make? And you can see here, you'll make roughly about a 740 crown profit, which is not bad. On a 760 crown investment to make 740 crowns back, that's a 97% return. And you have limited risk. No matter what happens, even if the stock goes all the way down to zero, you're only risking 760 crowns. That's the risk to reward ratio that you're taking when you're buying a call option. Now, what you can do is you can then take a look at selling a put option and see, well, how much money does a put option make if I get to my break-even price? Here, as you can see, if the stock gets up to 222.60, here I make $0 because I'm just at my break-even price. But if I sold the put, I make 790 crowns. So I actually make money if the stock goes in my favor, but not by a whole lot. It just goes in my favor. I make 790 crowns. And you learn that I also make 790 crowns roughly if the stock stays the same. So if the stock doesn't move, I still make money. And even if the stock goes a little bit against me, if it goes down to 210, I'm still going to make money. So I can get the direction actually wrong and still make money on this trade. So as you can see, shorting a put, it's a very forgiving strategy. I can make money if I'm right. I can make money if the stock doesn't move. And I can make even a little bit of money if the stock goes against me. The downside is that I start losing money if the stock goes below my break-even price here. So my break-even price here is 207.10 because if I take 215 and subtract 7.9 crowns, my break-even price is 207.10. The difference here is that the stock needs to be above 207.10 in order for me to be profitable. So this is where shorting the put is a lot more provides a lot more possibilities of making money. The downside of shorting a put is that if the stock keeps going lower and lower and lower, if let's say I'm wrong on my directional view and the stock starts to plummet, then what happens is that I take on significantly larger and larger losses as the stock keeps going further and further against me. That's the downside that you're taking for this high probability trade. But let's analyze it between these two strategies because, like we said, 222.60 is where we break even, but we're not here just to break even, right? We're here to try to make a profit. So what we're trying to understand here is when does it make sense to buy a call option versus selling a put? Because at 222.60, I make 790 crowns on the short put. So if you tell me between the two, which one am I going to choose? I'm going to tell you I'm going to sell a put option, right? Because that's the one that's going to make me 790 crowns in profit versus $0 in profit. However, how far does the stock need to go before the call option makes more money than the short put? And this is really where the P&L simulator is really useful because I can use the P&L simulator and see that at about 230.5 is when the call option makes roughly the exact same profit as the short put, about 790 crowns at 230. Now, we said before that our target on the upside is about 235. So maybe you can use that to plug that in and say at 235, okay, at 235, buying a call option makes more sense because I'm making 1,200 crowns versus only 790 crowns. But if let's say you're a little less optimistic and you think the stock's going to go to 230, then as you can see, the two strategies are virtually equal. If you think the stock's not going to get up to 230, you think it's going to get up to 225, then clearly the put option is better. So as we said, 230 is kind of that break-even point between the two prices. So you have to ask yourself, do I think the stock is going to be above 230.5, which is roughly here? And on the flip side, if the stock declines, right? So we said that the break-even price here is 207.10, 207.10. At that point, this short put no longer is profitable. But keep in mind that if the stock declines 207, here I lose nothing, but here I lose 760 crowns. So what you have to understand here is that the stock has to actually go much further to the downside before the short put is worse off than buying that call option. At about 199.60 is when the short put will lose more money than the long call. So 199.66 is about right here. So what you learn here is that anywhere in between here, the short put will actually be a better trade because within these two bounds, the short put will give you more profits than the long call. If the stock is above this level, that's when the call option starts to outperform the short put. And below this level, that's when the risk of the short call is less than the risk of the short put. So this is really what you start to see, is that it really requires a big move in this underlying stock, either higher or lower, before it's better off to buy a call. And if you think the stock is going to be more neutral and not move as much, that's where it's better to sell a put option. And this is just a more visual way of determining which levels where do you think the stock will be between now and November 20th? Because if you think it's going to be in between this level, if you think it's going to be in between these two price points, then perhaps you're better off selling that put option. If you think the stock's going to be a fairly significantly higher or lower, that's when you're better off buying a call option. Does that make sense to everyone? Please type 2 into the chat window if that makes sense to you. Because this is the toughest part to learn as an options trader, is to know whether you're better off buying that call option to take a bullish bet or selling that put option. Because that's the same decision that you have to make to decide later on, do I want to trade a debit vertical spread or a credit vertical spread? It comes down to whether you think the stock's going to make a big move or stay within a fairly tight range. And arguably, 199 and 230 is a pretty big range. That's not a small range. The stock trading at 215 right now. So 230 is another 15 points higher. 199 is another 15 points lower. That's not a small range for the stock to move between now and November 20th. And what you start to notice is that professional traders, generally speaking, will lean more towards selling more often than buying more often, because buying options only makes sense if you expect a big move. And it's not every day that you come into the market saying that I think the stock's going to make a really big move to the upside, or I think the stock's going to make a really big move to the downside. It's more likely that you come in and say, well, I think the stock is just going to slowly grind its way higher here. And if that happens, selling a put option will make more money in that particular environment. So that's really how professional traders go about looking at the markets, looking at the option premiums, and deciding when it's time to buy versus sell. And this is why options investors take a look at implied volatility, because implied volatility gives me an understanding as to whether 790 crowns and 760 crowns is relatively cheap or relatively expensive. Because when things are relatively expensive, guess what? I'm going to want to sell, because that's telling me that I'm getting more of a buffer. So the stock would have to make even a bigger of move in order for it to be profitable. If the premiums are low, if implied volatility is low, then the band is going to be narrower. So then there's a much higher probability that the stock's going to make a big move, perhaps, and that's why I might be better off buying. So whenever you hear about options traders talk about whether volatility is cheap or expensive, that's what we're talking about, because the more expensive volatility is, the bigger this range is going to be. The smaller implied volatility is, the smaller the range is going to be. So the smaller the range, the better it is for buying. The bigger the range, the better it is for selling. Does that make sense? Please type 3 into the chat window if that makes sense to you. Okay, great. So let's take a look at one bearish example before we open this up for Q&A. So the bearish example that I had up before was, Axe Food. I want to take a look at Axe Food. Whoops. And just so you know, this is not I'm just using these as examples. I'm not saying that these are bearish stocks or stocks that I think are going to move lower here per se, but you've got a nice little double top here forming here on Axe Foods. And maybe you think that this, 215, 216 level, which was a top here, around 217 or so during the coronavirus initial rally here. If you think this 215, 216 range is kind of a triple top here, you don't think it's going to get above it, you think it's just going to bounce lower like it did last time, maybe this is a trade that you're more bearish on. So what I want to do is explore buying a put option versus selling a call option. So here the stock's trading at 210, so let's use a 210 strike which is the closest at the money strike. So as you can see, to buy a put option would cost me about 560 crowns. Selling a call option will collect about $530 crowns. So if we use our P&L simulator, this allows us to then better understand what our break-even price is here. So the break-even price is 204. But again, remember, 204 is just our break-even. So at 204, we're not making any money. We're just not losing any money. The real break-even is actually a little bit lower here. So what you have here is a break-even of closer to, let's see, 530 crowns. 199 is the true break-even between these two strategies. So Axe Foods would actually have to be below 199 at expiration in order for the long put option to make more sense. Whoops, 199 here, 199 down here. It would need a move all the way down to 199 before buying a put option is more profitable than selling that call option. And what you have to remember is the fact that if, let's say, we're wrong and the stock doesn't move very much, the stock just stays around this 213, 214 range, if that happens, if you bought the put option, you would lose 100% of your premium. You would lose 560 crowns. But if you sold a call option, you would make 490 crowns. So you're much better off selling a call option if the stock doesn't move. Now, if the stock goes against you, that's really where the short call is at a disadvantage. And the short call allows you to take advantage of that premium, but you're taking on the risk that if the stock goes against you, you're going to lose substantially more capital on the short call if the stock takes off and continues to move higher. But as you can see here, if the stock moves higher, it's only at a certain point do you start to lose more money than what you risked with the long put, because the long put will lose money even if the stock doesn't move. Here, if the stock moves against you, you can still make some profits, but at some point you will start losing more than the 560 crowns that you're risking here on the long put. So here at about 220 is that break-even price here. So at 220, if Axe Food is above 220 or below 199, as we said. So if Axe Food is anywhere in between here, selling the call option makes more sense, because in between these two ranges, the call option will have higher returns. Up here, the put option will have smaller losses, and up here, the put option will have larger gains. So this is really how you would go about evaluating which strategy is best suited for your particular outlook of the underlying stock. And this is really where you can leverage some technical analysis skills. This is where you can leverage your fundamental skills to determine where you think the stock will be sometime in the future. And there's different forms of analysis that you can do, but options is a tool that allows you to profit regardless of what your views are. If you think the stock's going to make a big move, you might want to be buying that call or put. If you think the stock's going to stay relatively stable or stay, in a smaller directional view or more orderly directional view, then you might be better off selling that premium and collecting that premium. So that is the most important lesson that an options trader needs to learn before you start deploying these strategies in your own portfolio. So with that covers what I wanted to share with you here today, with some real examples of how to apply what we've learned. And more importantly, I hope that this showed you how to use OptionsPlay to set up your own strategies that you want to evaluate, and learn how to use the P&L simulator to simulate the different outcomes and what you can potentially gain from a risk and reward perspective of each strategy, so that you have a better understanding as to which strategy is best suited for your personal outlook. So with that, what I'll do is I'll open this up for Q&A here at this point. If anyone has any questions about what we discussed here today, or if you have symbols that you want to take a look at here together, I'm happy to pull them up and take a look at them. And while you submit your symbols, I will just show you a brief overview of what we currently see with the Nordic markets from the broader indices, and just give you a better understanding as to how we're currently looking at the broader market outlook. So if you have any questions regarding what I discussed here today, or any symbols that you want to take a look at, please type them into the Q&A window or the chat window on your screen. So what I'll do is I'll start off with the OMX S30. So the OMX S30 is the broad-based indice that will allow you to capture a sense for how the Swedish markets are currently doing. Some of you trade index options here on this particular name. So OMX S30 is still not back to its February highs of about 1900, but it continues to grind its way higher here. This has been a very slow but consistent grind. This, from my perspective, just requires patience because you have plenty of pullbacks, and each pullback has been a very good potential buying opportunity. Right now, you're near the upper bound of that range. So if you think of this as a bit of a range here, what you're waiting for are bounces to the bottom of that range and looking at those as buying opportunities. I wouldn't use them necessarily as selling opportunities because they are very shallow corrections here. I think that you have far better opportunities to search for these upticks rather than trying to trade to the downside, in my opinion. But the OMX this 30, as you can see, still below that 1900 range here. And my expectation is that you're going to get a slow grind up to that 1900. And if we use US equities as a bit of a template here, our expectation is that unless unless the number of coronavirus cases continue to accelerate to the upside and we get worse news on the vaccine front, if let's say vaccine news starts to deteriorate, we saw some of that over the past couple of days, but nothing just too alarming yet. But if anything further, such as clinical trials getting shut down or anything like that, that is the type of catalyst that could drive the market substantially lower. But unless that happens, our base case is that equity markets will continue to grind its way higher up to that 1900 level and potentially continue its way higher. And the best way to look at it is the Copenhagen or the Denmark exchange, where we've seen it greatly exceed the February highs of about 1400 and continue its way higher here. Now, what's interesting here about Denmark is that you had a very, I would say, orderly range before it broke out here to the upside. So Denmark looking substantially stronger out of the four Nordic markets in terms of where we currently stand. And then when we look at Helsinki, with Finland, what we see is that Finland looks very similar to the OMX S30. So still below that 4,600 February high, but recently trading in a very, what I would say, orderly range, if you will. And whenever it hits the bottom of that range, that's your buying opportunity. We got that here at the beginning of the late September. It's now near the upper bound of that range. So my expectation is that you're likely going to see a bit of a rollover before it can continue moving higher here to the upside. So that's how we're currently looking at the Helsinki market. And then lastly, when we take a look at Oslo, Norway being the weakest of the markets, as you can see, well, actually below the the August 2019 lows here. So this is the middle of 2019 lows. We're still below that level here. So Norway looking substantially weaker from an equities perspective, and actually, not making new highs, actually making lower highs and lower lows. This speaks to further potential weakness here for the markets here for Norway. So out of the four major countries, you have Sweden and Finland that look very similar, slowly grinding their way back up to those February highs. You have Denmark that's clearly the outperformer. So if you're looking for performance, I certainly would steer more towards the Danish markets than, and there are still plenty of opportunities, in my opinion, for the Swedish and Finnish markets, but the Norwegian markets, I think that is going to be the weakest one. And if you're looking for short opportunities, you're better off looking for short opportunities in that Norwegian market. So that's just my brief overview of the broader markets. And so let's turn to some of the questions here that we've received over the past few minutes while I was going through that. So one question is, what about earnings and dividends in this scenario? So Anders, generally speaking, when you're trading options, you don't really have to worry about earnings and dividends you don't have to worry about dividends too much. You do have to worry about earnings, right? So for example, earnings is one of the major catalysts that could move something very far. So Axfood here reports earnings here in 8 days. So at the bottom of your screen, we have earnings. So you can then factor that into your views here. So earnings is one of the things that could potentially move this market a fair amount. So you might say to yourself, okay, I'm bearish on Axe Foods, and because earnings is coming out, I think it's going to make a big move. Then maybe that is a good reason to be buying that put option versus selling that call option. And many investors will say that because of earnings coming up, I don't want to take on unlimited risk, right? Because the stock may be on some unexpected good news really pops higher, and here I'm losing a substantial amount of capital. So great question. But I will say that I think earnings is really something that will have a much bigger factor rather than dividends. Dividends, generally speaking, is not something that is a huge factor in determining what strategy is best suited for your portfolio. How to use standard deviation in this scenario? So as you can see, one of the things that you'll notice is that if you use the standard deviation, the trading range, before I said that the trading range here was about, I said the upside here is about 220 is when you start to make money, and to the downside it was about 199. And we basically said everything in between, the call options are better, and everything outside of that, the put options are better. And notice how the trading range simulator will give you numbers that are very close to that, 196 and 223. It's because we're using implied volatility to calculate that standard deviation. So this is another way to decide roughly what that trading range is. If you think the stock's going to trade outside of that range, you're better off buying options. If you think the stock's going to trade inside of that range, you're better off selling options. So that's what the trading range simulator is really designed to do, is to give you a better understanding as to when, or at least inside of the prices, as far as when it's better to sell options, and outside when it's better to buy options. So Anders, I hope that that helped answer your question. Selling a put option, will that generate additional costs? So yes. So when you sell a put option, you're going to have to put up margin. So when you're selling a put option, you have to post a certain amount of margin to enter that contract. But that's not a cost. That's just money that's set aside in order for you to enter the trade. You get that money back once you exit the trade. The only difference in terms of change in your account is the P&L difference. So when we talk about losing 1,400 crowns, that's what you're losing. Whatever margin that's required for you to sell that call option to begin with, that margin will be returned to your portfolio. So yes, there's a different, I would say, opportunity cost. It's not a real transaction cost. It's just an opportunity cost, because once that buying power is removed from your portfolio, you can't use that cash to, let's say, buy a put option or do something else with it. Sigvard is saying, is there an efficient way to track implied volatility per stock in OMX S30? Can this be found in OptionsPlay? Where to store interesting trades in OptionsPlay? How to delete these? So Sigvard, so first of all, for any stock that you want to take a look at, we show you the current implied volatility right here. So Axfood, the current implied volatility is 19.8. You can click on any other symbol like Swedish Match. You can see Swedish Match implied volatility is 30%. So significantly higher implied volatility on Swedish Match versus Axfood. So that's one way for you to take a look at the implied volatility of individual stocks here on OptionsPlay. As to where you can store interesting trades, if let's say you find the Swedish Match trade is interesting, you can click on the blue arrow, and when you click on this link here, copy to clipboard, what that does is it saves the trade in your portfolio. I'm sorry, in your profile. And once you click on this link, what it'll do is it'll generate these images and the share link, which you can find in your profile. If you go to your profile, you go to shared trades, a history of all your trades are here, and you can click on the link and it will take you back to the page that you created and the trade that you've created, and it'll track the P&L of your trade as well. So it's a great way for someone who wants to track a trade to be able to quickly look at some trade ideas. Take a look at some trade ideas and see the trade that you made for your portfolio. So that's one way that you can do it. Now, the only thing that you're not going to be able to do is delete a trade. Once you've shared it, it's going to be in there. You can't delete it. It's because we're generating a link. You can use that link to share it with a friend. We just want to make sure that that link doesn't break because you've closed out that trade. So here you get to see the trade, and it'll track the trade for you if you open it in your portfolio. Is there a difference in strategies if you trade indices? No, there isn't really a difference between indices and stocks. The only difference between indices and stocks is the fact that they're cash settled. So you don't have to ever take delivery of the underlying stock or asset. They are the one benefit also to trading index options is the fact that there's no earnings, so that you don't have to worry about a big jump in an underlying stock because an earnings is coming up. It diversifies away your single stock risk, but that also means that indices, generally speaking, will not have large moves. They tend to be slower moving than individual stocks. So there are some pros and cons to trading indices, but OMX S30 is one of the most widely traded derivatives products in the Nordics. And what that also means is that it's one of the most liquid products. So you can trade you can trade hundreds and perhaps even thousands of contracts of OMX S30 without necessarily moving the markets. And that's not always true for every single stock that you're trading. Is it required to own the underlying shares in order to sell a put option? No, you do not need to own the underlying shares before you sell a put option. And keep in mind that this is more of an educational session. I'm not necessarily saying that the best strategy is to sell a put or to sell a call option. What you're going to learn down the line here, let's just go back to AxFood for real quick. What you're going to learn down the line is that selling a call option, I would never recommend selling a call option naked like this, because selling a call option truly has unlimited risk. And I don't advocate most investors to take on unlimited risk. What I much rather prefer that you take a look at is selling maybe the 210 call. And then what you can do is you can buy back maybe a 220 call against it. And what that does is it caps your downside risk. And what this does is it gives you the same risk profile, but without the unlimited risk part. And what you give up is a little bit of income in exchange for not having that unlimited risk. So this is the actual strategy that most investors will actually deploy in their strategy. But before you can learn about these strategies, you must first learn the fundamental building blocks, which is why you want to sell a call option first, what the benefits are, and what the risks that you're taking to do so. Once you understand it, once you're able to better understand whether you're better off buying that put option or selling that call option, once you made that decision, you can always make modifications to it to reduce the risk. You don't have to take on unlimited risk. I actually don't think you should take on unlimited risk. So what you can do is, instead of selling the 210 calls for 580 crowns, what you can do is you can pay a 1.65 crowns to buy the 220 call option. And now what you collect is only 415 crowns. So you're reducing your income by a little bit, but you're not taking on unlimited risk. And so that's what we're going to cover on the next course, is once you learn these fundamental building blocks, how do you take it to the next level for strategies that you will actually deploy in your strategy? Where should you say pop should be at for percent to take a trade? So that's a common misconception that I think a lot of investors don't really understand about options trading. And a lot of people want high probability of profit. So there's this metric here, probability of profit. And you'll notice here that when I sell a put option, or let's go back to the original use case where we were comparing buying the call option to selling buying the put option. So notice how big the difference in probability of profit is, right? One is 35% and one is 67%. Now, let me ask you, what's better? Most beginners will say 67 is obviously better, but guess what? You know, is 67% really better if you're taking on unlimited risk? Do you want higher probability of profit, but then potentially the risk of losing, 1,800 crowns while buying a put option only risk 560 crowns? The answer is there's no such thing as what's the best probability of profit. The question is, what's your risk to reward that you're taking on for the probability of profit? That's why we built the OptionsPlay score. The OptionsPlay score takes into account both factors. What is your risk to reward and what is your probability of profit? Because anything with a high risk to reward will give you low probability of profit. Here, I'm risking 560 crowns and my max profit is 20,000 crowns. So whenever I have really high risk to reward ratios, I'm going to have low probability of profit. Here, I can only make 580 crowns. That's my max reward, but my max risk is unlimited. So when you have that type of risk to reward, you're naturally going to have higher probability of profit. So the answer is, don't just look at probability of profit. If you're looking at probability of profit alone, that means you've lost sight of what is really important. What's really important is the balance between these two things, because probability of profit and risk to reward are always at opposite ends of the spectrum. If you can't have both, you either have high probability of profit with low risk to reward, or you have low probability of profit with high risk to reward. One is not better than the other. The question is just, what do you prefer? And the answer is also based on what your outlook is, right? Because if your outlook, if you think the stock is going to stay the same, it doesn't matter how high the probability of profit, or I'm sorry, if you think the stock's going to make a big move, it doesn't matter how low the probability of profit is. I would much rather take a low probability of profit trade and potentially make 200-300% return on my capital, versus if I sold the put option, I can only make 580 crowns no matter whether the stock makes a big move or if the stock stays exactly the same. I'm only going to make 580 crowns. I can't make any more money if the stock makes a big move if I sell the put option. So there are a lot of factors that you should be paying attention to before you look at probability of profit. A lot of investors spend too much time, in my opinion, looking at probability of profit and not looking at some of the other factors that I think are actually more important. Let's see. Today, the difference between the OMX S30 and the OMX was about 8 points. I want to tell someone, I want to sell some contracts of the hedge. I picked the K. I think you're talking about futures now, but I feel very uncertain about what will happen until Friday. But I feel very, is this backwardation? So I'm gonna have to, if you want to send me an email at info@optionsplay.com, you can. I don't know if it's backwardation or not. I haven't taken a look at the futures curve, but from my perspective as a futures trader, you should only trade the contract that's most liquid, which is the front month. Now, if the front month is about to expire, so if that expires this weekend, I think now is the time to start trading the next month. Meaning if October 16th is when the futures that you're talking about is about to expire, I would not trade that. We generally stop trading the front month futures about 3 days from expiration. We usually roll to the back month about 3 days before expiration. So, if that's what your question is, I hope that answered your question as far as which one you should trade. Any other questions? If there are no other questions, I just want to, again, thank everyone for taking the time out here this evening. I hope that this was useful in helping give you a better understanding as to truly the difference between buying versus selling options. Because like I said, without a good understanding of that, all future more advanced strategies will become a really big struggle to better understand when you should do which one, whether you should trade a calendar, a diagonal, a debit, or a credit spread, condors, butterflies. These are all based on these fundamental building blocks. Once you understand them, all complex strategies make a lot more sense, and it's going to be much easier for you to decide which strategy is best suited for your particular outlook that you have on the underlying stock. And once you have it, no matter what strategy someone throws at you, even if it's a completely custom built strategy, you'll be able to understand that strategy because you have a good sense for the fundamental building blocks. So make sure that if you're still in the learning stages, to take the time to review this course with the previous 2 courses that we just posted in the link into the chat window. I'll post that link again here. It's for those of you that missed that. And also for those of you that have access to OptionsPlay. If you don't have access to OptionsPlay, you can sign up using optionsplay.se. That's the platform that I just used to show you the ability to compare strategies side by side. It's a free platform that NASDAQ is provided to all Nordic investors, and it provides you with real-time quotes, gives you access to education like the one that we're hosting here, and a ton of resources to help you learn more about options trading. All of our webinars have been recorded so that you can watch them at your own pace. You can watch these, all the slides are also available for you to download so that you can download the slides, follow along at your own pace, and really take the time to learn options trading properly. And then ultimately you have access to the platform OptionsPlay completely free of charge for you to start exploring and learning and before you and understand your risks and rewards before you execute them into your broker's platform. And once you're ready to trade them, we have these short codes that you can copy and paste into your Nordnet or Avanza platform, and you'll be able to instantly execute these strategies at your broker's platform once you click on that trade button. So we really built this to try to make this as easy as possible. We'll actually be sending out a survey to many of you over the next couple of weeks to ask for some of your feedback regarding the education, the platform, everything that you've received as part of the NASDAQ Nordic package that they've put together to give you an opportunity to give us some feedback to understand what you need in order to continue your options trading experience. So with that, I look forward to continuing to help everyone learn how to trade options. I look forward to your feedback to the survey to give us a better understanding as to what you need to progress your options trading going forward. So with that, thank you so much. I hope that you guys have a great evening, and I'll see you guys here on the next options education session. Thank you and have a good night.